Okay. I hate this transcript. Now, so now we're going to go through problem P-1A. Let's see this together. So you know that the procedures, how we're going to solve those kind of problems. September 30th, 2020. Right, so September 30th. Okay, make sure we understand the date. So the balance sheets of Croc products reported the following. We have our account receivable total 310,000, and we have an allowance for doubtful accounts. So this is on the credit side, right? We have 10,000. Now, during the last quarter of 2020, the company completed the following select transactions. So on December 30th, we write off Barry White $2,500, Carlos Media $2,200, and Doug Zabalos $1,100. So those are the total amount we write it off at the end of the December. Now, December 31st, we recorded bad debt expenses and based on the aging of account receivable. So they give you the tables of the total account receivable amount and also give you the estimate percentage on collectible. Not for this question. I think there's another question. Give me 1 second. I'll quickly call that. They didn't give you as this, right? They didn't show you the percentage at the end of each company, but they do let you know for they give you the information saying from the current month you got estimated 1%. From the prior month you got a 3%. For from the 2 months prior you got 6%, 3 months prior 20%, and then the 4 months prior 40%. It's exactly like this how that shows, right? So you can see the current will be 1%, and then you just for the prior month is to the match estimated percentage on collectible. So that is for a next question, I think, when you do your practices. So make sure that it's not just following like 1%, 3%. You have to take a look at the month because they didn't give you the days. They give you like March, April, May, June, or July. Okay, so you have to go from the July, that is the current month, and then June is the prior month, right? Something like that. Now, we keep going with this question, examples. Give me 1 second. So we know first requirement, we need to record the transaction in the general journal. What we need to do, the transaction in the general journal is just for December 30th and December 31st, right? So for December 30th, we need to do a journal to record this write-off. We all know that if we need to write off the total amount, we debit our allowance for doubtful accounts and credit those 3 account receivable for each company. So we credit Barry White's $2,500, credit Carlos Media 220, and then 1,100. Then the total amount for the journals will be 5,800. So that is for the first December 31st journal entries. Now, when you move on to December 31st, you need to record the bad debt expenses. What is the first step we need to do? We need to calculate the required credit balance. Remember the age of account receivable method. The calculation when you come out is give you the required credit balance. It's different. Okay, I'll quickly just show under Excel. The aging of account receivable and the sales of account receivable are exactly the same. So what we need to do is okay, let's put then we'll go like this to make it easier to see. Now, we need to do the calculation first. What we can do? We already know that we have 0.1% for the 1 to 30 days. We simply use account receivable total amount times That's 0.1%, right? Plus 95,000 times 0.3%. Then when you add those up, you should come out with a number. That is 9139. This is your desire. This is your desire balance. The way you calculate your bad debt, that is your desire balance. Then what you need to do, you need to calculate the adjusted balance. This adjusted balance, what is it? How are you going to calculate? We need to know the beginning balance before adjusted, and then we use the targeted balance to deduct the beginning balance, right? So you have your adjusted. This number will go to your journal entry on December 31st. So how are we going to calculate the beginning balance? We all know that the question already gave to us. We have our allowance for doubt account is $10,000. Okay, so we put $10,000 on the credit side. And then what we did for December 30th, we write off 3 companies' account receivable that we cannot connect it at all. So we do remember the journal entry we did. We debit our allowance for, I'm not going to finish everything. So our doubtable accounts, and then we credit the 3 companies. Okay, so Barry White, account receivable, CM, account receivable, DZ. So those are the total amount will be 5,800. This is already given to you from the question, right there. This is also the journal entry, the very steps already to finish it. Right. Now you already know that we write off, we debit the 580. So into our T account, we put onto debit $5,800. So the total balance we left is in there at 4200. You use the 1,000 minus 5,800. So you have 4200. Now you know your 4200 and know your target balance. This one will be the 9139 deduct 4200, which is 4939. Right, so this will be the one you put into your December 31st journal entry. Is debit, that expense, and then credit your allowance for double account, right? So that is how you do the first question. And then when you move on to step number 2, it's very similar. They just ask you, open allowance for this T account, right? The ledger account, and post the interest affecting the account. That's exactly what we did already. We have our balance started is 10,000, and then we have a write-off 5,800, and our balance is 4,200 under credit side. Then we have 4939 under credit side, which is adjusting account. Then we have our ending balance 9139. So that is for step number 2. The questions I have, number 3 is asking you to have comparison, right, for the balance sheets, comparing the 2 years. For 2019, it's very easy to give to you already. So your account receivable, $320,000, and you have your bad debt for doubt account is $12,000. So 2019, you just simply use this 320 deduct 12, and your account receivable net under your balance sheet will be 308. Now the question is for 2020. Now I'll put into the similar. So the 2020 is, we need to know our account receivable at beginning of 2020. Put in there. So we have our 2020. Then we should put on no, I should not do that. Just simply put in there. So this is for account receivable, and this is for allowance. And we have our account receivable let. So for 2020, we need to find it out what is the total account receivable. It should tell you from the question. So right there, there's 328,500. This is our total account receivable for 2020. So we leave this total amount under 2020 balance sheets. Now, what is the total allowance for doubtful account? We have calculated, right? Already, it's right there. So have here, and then our net will be this two $328,500 deduct the allowance, which is 319,361. So that is how this gonna affect your balance sheets. Then the last question, they want you to change a method. The first one, we use the aging of account receivable method because they give you the percentage, right? And then the number 4, they give you 4% is the account receivable balance. So you just simply use the total amount, what you got for the whole year, 328,500 times 4%. So that will be your required credit balance, similar to what you did here. Now we simply used required credit balance in allowance for doubtful account. We're using percent of account receivable method. So that's a little bit different than what we did before, but it's exactly the same on T account, how the T account works. We use total amount times 004, then we got 13140, and then now all we need to do is the credit balance in allowance for doubtful account before adjusting. So that is where you come out with the 4200, right? And then this is the credit. You need to adjust it to produce required credit balance. That is A940. So I have students to have question on how you get A940. That is how the procedures get you. You have your target 13140, and then you had your beginning balance 4200. So this is the one that you need to make adjusting. Then when you need to make a journal entry to record the bad debt expense, that will be A940, and then you credit your allowance. Does that make sense? So that is basic. Yes.
Sorry, the 13,140, like that's your new allowance for doubtful account target, right?
Yeah.
And then so the 8,940 is to adjust.
Right.
Okay.
Right there.
Yeah. Okay.
So we are using this 4%, which is the percent of account receivable method, because the first one we did is the aging, right? Because give you each percentage for each account. So this is the method we're using for aging of account receivable. This is the percent of account receivable. So they give us the 4% is on connectable account. So we use the total 4% times the total account receivable for the whole year. So we have this required, this is right there, here. So this is the required total amount for a allowance for doubtful account. And then you need to calculate adjusted account, which is A940. So that is the bad debt expenses you put into your journal, right? Perfect, great. So yeah, so this is how the procedures are working for those kind of situation question, but you're not gonna see that complicated question in your final exam. It's gonna be simple, easier. You just simply maybe calculate it, use the aging of account receivable, and then calculate this total amount, put it into a journal entry. That is how you simply gonna do. Now, so we finished chapter 9. Now we move on to chapter 11. That is our last chapter for level 2 course. Okay. As I said at the very beginning of our course, the textbook is the best resources for the whole financial accounting, because the textbook just give you a lot of examples and give you very clear states for each principles. So I will recommend you to read through, because it's a really good book for financial accounting. We're gonna do this is chapter 11. No, this is chapter 7. Where's the chapter? Right there. Yeah, current liabilities and payroll. Pay attention to this. No, after I finish chapter 11, we're gonna quickly go through those final exam questions. It's not, I will show you that which question you need to pay attention so you can have a well prepared for your final exam for tomorrow. Okay. Now, current liabilities. There's 2 topics you need to pay attention. First of all is to calculate your interest. Okay? You had a question on that as well. And then the next one is the payroll. How to do a payroll journal. So that's very important in this whole topic. Now, first of all, what is current liabilities? We have already learned it from our chapter 4. That is from the level 1 class. Current liability is a liability due within no less than 1 year. Okay, so the amount of some current liabilities is known. Account payable, which is our amounts owed to supplier for goods or services purchased on open account. Now we have a short-term notes payable. We're going to talk about that. This is too big. Okay. So what are current liabilities? How do we account for them? They'll have account payable defined, right? Less than 30 days. And assuming examples, November 22, Break Brewing Corporation Limited purchases inventory or credit $600. We know that when we need to record this transactions with debit or inventory credit account payable. Right? And then after December 5th, we paid off. So we decrease our account payable and decrease our cash $600. Now, then we move on to short-term notes payable. The short-term notes payable is very similar to the account receivable we talked about last time. It's just promissory notes that must be paid within 1 year. Now, assuming that October 31st, 2019, the company purchased a inventory costing $16,000, issuing a short-term 10% notes payable. The entries were recorded: debit, inventory, credit, notes payable. The only different notes payable and the accounts payable is this is the notes, right, with the signatures, with all the detail. And also when you need to calculate the interest, it's not deduct your notes payable, it deduct into your interest payable. So when the year end, you need to accrue the interest. We have learned this from level 1 as well, it's accrued expenses. So if you need to accrue the interest, you need to record it. Okay, so the notes coming on December 31st, which is 2 months already. So this is much simpler because you just simply use 2 out of 12. If there's a date, like 90 days or those kind of thing, you use 90 divide by 365 days, right? You have to use the same dates. Now, so for this one, it's very simple. You use principal, 16,000 times the 10% annual interest rate, then times the time already passed by, which is 2 months out of 12 months. So when you recorded this into your journal entry with debit, interest expenses, credit, interest payable, because our interest payable liability increased, okay, the expenses already happened. Then after 1 year, the notes mature, then the journal entry, you need to record it as the principal total amount, then the interest payable, which already incurred, plus the rest of the 10 months of the interest. When you calculate it, the rest of the 10 months, you use principal times 10% times the 10 months out of 12 months. So this is how you calculate it for the interest expenses. And you record it into your journal entry by credit your cash. Right? You add all those up. This is the total cash you pay back for the notes payable.
How
So
come
if
you're only,
yeah,
how come for the interest payable, how come you're only doing, like, I understand the October 31st to December 31st that you have to put what's already occurred, but how come you're not doing that again from January 1st on? Like, I know, like, do you understand what I mean? Why is the interest payable only for the previous year?
because this is not for, this is because December 31st, we're assuming is the ending period of the accounting period. So the company always had a balance or financial statements be ready at the end of their ending period, right? So you need to put, why we need to do this journal entry is because we need to put this expenses into our income statements. So it will show you that we had interest expenses happened, then it's not overstated for the following years. Because if you're not doing, so if you're not doing this calculation, you're not going to deduct these expenses from your income statements, which means your net income will be overstated, right? But if you recorded this interest expenses happened, then it's more accurate to state into your financial statements. So that's why we need to do, right.
And then your interest expense from January to October will get reported again in December of the next year?
Right.
As an expense?
Yeah, because this, remember, this notes will mature in October the next year, right?
Yeah.
So this whole, when the notes has been mature, what we need to do is we need to record the total cash we've been paid out. So you can see that everything has been paid out. We didn't even just pay $16,000, even though we had this notes payable on $16,000, but we actually paid out $17,600 because the interest included. So at the end of the December 31st, 2020, you do not need to list it all those interest payable. You just simply listed the total cash to be paid out. So you do not need to do this again, like interest expenses, interest payable journal. You just simply record it into your journal entry, into your financial statements, and seeing that we have been paid total cash $70,600 for a notes payable account. Am I making it clear? No?
Yeah, so then the interest pay, like, I understand that part, but then the interest payable or the interest expense from January to the end of the note, which is October 31st, that just is part of the interest expense, like the calculation, the 1333.
Yes, you're right. Yeah,
Okay.
totally right.
Okay.
Right. Yeah, so I know the interest calculation is kind of a little bit different than what we did before, but yeah, you're totally right. Now, in addition to recording the notes payable and the payment maturity, business must be sure to properly accrue the interest expenses at end of any accounting period due to the time period assumptions that expenses criteria, right? So that's why we did on December 2019, the previous years, we have to record interest expenses and interest payable. Now we move on to the short-term bank loans and a line of credit. Short-term bank loan and operating line of credit are arranged with a bank or other financial institution. Short-term bank loan is very similar to short-term notes in that they're for fixed times, right? Less than 1 year. Interest is paid on the principal. Operating line of credit is like a bank loan. If you're not using it, you do not need to pay tax, interest, I mean. Okay, so if you just sit in the line of credit account, you do not need to pay any interest on that. If you use that money, you need to pay the interest on how much you've been used. So it's kind of a little bit a little different one. But you can also open your personal interest line of credit, right? So that's the same. You open an account, you have $10,000 in there, but you not use it, you do not need to pay any interest on it. Now, the next one is the sales tax payable. Sales tax payable reports the sales taxes, typically GST, HST, PST, that are connected by business and that must be periodically remitted to the appropriate taxing authorities. So GST, you need to remit it. We're gonna see examples in there. So GST and HST, the rate charged is based on the good and service that is being sold. The category it belongs to. So all businesses connect the tax on sales and deduct the GST or HST they paid, which we call this input tax credit. And then we pay the differences on a quarterly or monthly basis to the general server. The journal entries for both are the same. The key differences is the tax rate we use to determine the payable and recoverable. Okay, so for example, the GST is mandatory in all provinces. The PST and HST varies by different province. For GST, Alberta only have 5% GST. We do not have PST in here. Ontario, we use the HST, so 5% GST, 8% PST. Saskatchewan, 5% GST and 6% PST. So GST is always the same, as just the changes of the PST. Depends on different province. Now, PST, I want to show there's examples in there, right there. Okay, so we're assuming a business that operates in a province without PST purchase equipment. So assuming Alberta, I guess. So they're $2,400 plus 120 GST. A further $100 plus 5% GST, $5 GST was paid for advertising expenses. So the total has been GST been paid is 125, right? And then the business is making money. So the business is create a service revenue, which earned was $4,000. The GST connected is $200 based on the 4,000 times 5%. Okay. So when you do a journal entry to record it, July the 2nd, we purchased the equipment, spent $2,400, and we spend our total cash $2,520. So GST has been paid is $120. Then we purchase some advertising expenses. We spend $100, and we spend $5 on GST. Then we made a revenues, right? We sell service revenues. We connect cash $4,200. Then we connect $200 as GST. Then you need to remit the GST to the general government. What you need to do is we record the total GST $200 we connected, and we recorded the 125 GST we actually paid out. So which means there's a 75 difference, then we need to submit it to the government. That is how this journal entry recorded. So the GST connected, less that ITC must be remitted to the receiver general. This is $75. We need to pay more. That is for GST. HST, so it's very similar to the GST parts actually. So we just simply calculate the GST we connected and then connect the total amount we actually paid out. So the differences will be the one you need to submit it to the government. The only different things is for the provincial sales tax, because provincial taxes, we know that is only being charged for the final customer. So if there is a retailer, the retailer sell the products, the retailer will connect the PST. But if the retailer purchased the product from a wholesaler, the retailer does need to pay PST to the wholesaler. Okay, the PST only works for the final customer. So the sales, when we go there, so PST is connected only by the final seller. Wholesalers and retailer do not pay PST, and it's recorded using a similar journal entry as show. as what the GST recorded. You just simply record it as cash and credit your sales tax payable. And the sales taxes, like you pay it off, it's just that you debit your equipment, and then you debit your sales tax recoverable, and you credit your cash, right? And calculate the differences between them. So the total amount is very similar to the GST. The total amount remitted is the amount you connected. So how much you connected, you just submit to the government. The current portion of long-term debt. The current portion is the principal portion of a long-term installment debt that is payable within 1 year. So since the current portion can be material, so we have to record it separately into our balance sheets. Like you listed your long-term debts, and then you have a current portion of long-term debts. So you have to record it into your balance sheets. That's simply just listed in there. Accrued expenses. Accrued expenses, we've been talking about this, right? Basically, we use a salary payable. This is very easy understanding examples. But accrued expenses, we also sometimes call accrued liabilities. Those are expenses incurred but not yet paid. Or we first talked about it before when adjusting interest were studied. Example discussed in this chapter, including accrued interest and accrued payroll liabilities. We'll see if there is examples in their show. Yeah, we're gonna have unearned revenue shows. But anyway, so unearned revenue means you got the money, but you haven't provided your products or services yet. So which means you owe the person who paid you. It become obligations. Okay? Now we see examples for unearned revenue. On September the 3rd, 2020, a subscriber pays $20 to Roger Publishing for annual subscription. So Rogers would record the entry. Receive the money for a whole year subscription for $20. We credit our unearned revenue, $20. Because, you know, when you purchase those magazines or subscriptions, you pay the money first, okay? And then you use it for the following years. Then at the end of the December 31st, decrease the liabilities, increase the revenue, which means already provide some of the products or provide some of the services to the customer. So we recognize this revenue. We debit our unearned subscriber revenue, which is our liability decreased. Okay? And then we recognize the revenue is realized. So we credit our subscription revenue. How you calculate this is very similar to your interest expenses. We'll use $20 times 4 months out of 16. Okay. So that is the unearned revenue. Now is the customer deposit payment. Customer deposit payment represent amounts received from customer as security on borrowed assets. We've been doing deposit payment for the utility bills. They're like car rental, all those kind of things, right? So it's a security. The most common examples like utility companies who often charge a deposit as a protection against the damage or the theft of property used by customers. We do not provide any examples on there, but easy understanding. Now, next we wanted to talk about why would we need to estimate liabilities and how do we account for them? A business may know that a liability exists, but not know the exact amount. So it cannot simply ignore the liabilities. In most cases, a reliable estimate can be computed and recorded, and therefore must be reported on the balance sheets as well. Some current liabilities must be estimated if the amount is not known. When the estimated liability is recorded as a credit, the corresponding debit is usually to expense. We're going to see examples from there. Here. Now, the warranty, right? The warranty agreements are guarantees. that companies make concerning defects in their product. Because some warranty agreements last several years, the exact amount of repair required under the warranty may not know for several years. So the warranties, see, you purchased a computer and then you purchased the warranty for a whole year. You have no idea, like as a seller, you have no idea which month you might gonna pay this money to repair this product, the computer. Okay? So when we have a warranty agreements, the matching principles required that the warranty expenses relating to sales in any period be estimated and deducted from the sales revenue. A liability, estimated warranty payable for the estimated repairs must be reported on the balance sheets. Now we're going to see the examples in there. The warranty payable. 2019, company has sales of 80 million that is subject to a 1-year warranty. The company believes that 1% of the 80 million sold is the appropriate estimate of the cost of a warranty. Now we need to do a journal entry to record this. We debit our account receivable, 80 million. And then we credit our sales revenue, 80 million, right? This is sales on account. Now we have to record the warranty expenses. We use 1% times 80 million, so it's $800,000. So we debit our warranty expenses and credit estimated warranty payable, $800,000. Then, assuming the cost to repair the merchandise total is $700,000, which is already happened. So this is the real expenses happened. Now we need to record this. We debit or estimate warranty payable, which you already said account before, okay? And then you credit your cash. This is the repair costs you already spent. Now, if the product is replaced, the journal entry will have to be, we debit our warranty payable the same, but we credit our inventory. So this is a replacement. The real inventory decreases instead of the cash. So that is how you record it for a estimated warranty payable. The lawsuit. No, we're not talking about, yeah, we're going to talk about lawsuit later. But right now, when this is estimated for warranty expenses, now there's a vacation pay liabilities. The vacation, companies that they wanted all the employees to take the holiday off. So the vacation pay is estimated and accrued in the same period as the employee are working and earning the vacation time. We know that, for example, sometimes some of the company provide 2% of your total earnings for your vacation pay. The others maybe provide 4%. So we'll see how we're going to record the estimated vacation pay liabilities on the company's record. So January payroll is $100,000. Vacation pay is 4%. So we use 4% times $100,000. That is estimated is $4,000. When we record this estimated vacation pay, we debit our vacation pay expenses, we credit estimated vacation pay liabilities. So exactly like the way we record our warranty payable liabilities. So when we record this on January 31st, now in August, summertime, employee will take their vacation off. Now we need to record it and decrease our liability, right? So we have to estimate the vacation pay liability, we decrease the liability at $1,000, salary expenses $1,000. Now then we credit our cash, or various withholding accounts or cash. So that is the money we paid off as a company side, employer side. This is a record. We need to record the payment of salary and vacation pay. I want you to pay attention to this. You might gonna see a question ask you to record for a estimated vacation pay liabilities. Then you need to use your total payroll times the percentage of the vacation pay and times the percentage that the people will take the holiday off. So for these questions, for example, the company has over 100 employees. The January payroll total is $100,000. The vacation pay is 4%. Now the company assuming that the total 80% of the employees will take the holiday off during the summer. Now, summertime, when you need to do the journal entry, you need to use your total payroll times the 4% times the 80%, because that is estimated total amount. Okay, that makes sense. Now, that is the income tax payable for a corporation. Corporations are required to pay tax and make installment payment during the year based on their estimate tax for the year. The entry to record 100,000 monthly income tax installment is we debit our income tax expenses and credit cash. Easy, simple. Now at year end, the corporation calculating the actual tax expenses for the year is 1.24 million. The company pays the last monthly installment of 100,000 and accrues additional 40,000. Now we need to record this additional 40,000 on December 31st. We just simply use income tax expenses 40,000 and credit our tax payable. Okay, so that is a simple income tax payable recording. Now this is a lawsuit. Contingent liabilities is the lawsuit. It's a potential liabilities that depends on the future event. So we will show there's a 3 category to make sure if it's likely happened or unlikely happened for the lawsuit. And how are you gonna record that? So the outcome is uncertain, okay, and will be determined in the future. So from our there's a CPA Canada handbook for accounting. The generally requires contingent losses to be accrued or disclosed in the financial statements. So when you take a look at this exhibit, the guidelines for the reporting of contingent liabilities is based on the level of uncertainty and abilities to reasonable estimate amount. Now when you see if it's likely happened, like the loss will be likely happened, amount can be reasonable estimated, we have to put this amount reported as a current liabilities. If this total amount cannot be reasonably estimated, but the lawsuit will highly likely happen, there is a notes disclosure is required. You do not require to put into your balance sheets, but you have to put into your notes at the bottom. If the uncertainty, if the lawsuit is unlikely happened, if the loss will be significant, we just simply put into a notes disclosures. If the loss will not be significant, we do not need to do anything on that. Okay. Now, if it's not determined, unlikely or unlikely happened, the notes disclosure is required. You just need to write it down for the future happening or the possibilities of the future losses. Now, ethical issues in accounting. There you go. Ethical issues are involved in accounting for liabilities. Owners and managers may be tempted to overlook some accrued expenses and contingent liabilities. Now, doing so creates a more favorable income statements with higher net income or more favorable balance sheets with a lower debt to equity issues. So ethical issues is always being the very important one. We need to talk about it for each chapter, right? Now, when we move on to the learning object number 3, that is the payroll amount, which is the one that you want to pay attention because you're going to see the question in your final exam. How are payroll amounts calculated? There are numerous ways to express an employee's pay, such as salary, wages, commission, piecework, bonus, and benefit. Employees are paid a base rate for a time period. We call it straight time. Any additional hours, we call it a overtime, right? 1.5 times your base pay. For accounting purpose, 2 amounts are very important. First, gross pay, and second, net pay. Gross pay, right there. Gross pay is the total amount of salary, wages, commissions, and other compensation earned by the employee in the pay period. It is amount before income tax and before other deductions. Gross pay is the employer's expenses. Okay. Then net pay is a gross pay minus all deduction, is the take-home pay. So the paycheck, the total amount in your paycheck is your net pay. Also known as, because net pay equals the amount of cash the employee will receive. So it's on your paycheck. Employer act as a connection agent on behalf of the government and connect an employee's income tax, CPP payments, EI payments. These amounts are deducted from employee paychecks and are called a payroll deduction. We're going to see an exhibit to illustrate a gross pay and a net pay. Payroll deductions may either be required, like income taxes, or optional, like charitable donations or dues, right? Professional dues, those are optional. After being withheld, payroll deduction become the current liabilities of the employer, which assuming there is a responsibilities for paying the outside party. We're gonna see examples in there. Employer payroll costs. Yeah, so employees, you need to pay CPP, EI, right? So employer match your CPP contribution. So how much you pay for your CPP, employer match the total amount. But for EI, how much you pay, the employer has to pay 1.4 times the employee's contribution total amount. And works compensation plan premium, that is kind of a little bit different because it depends on the class of your work. See, some of the work is more dangerous and easy to get hurt, then the rate will be higher. If you're just like salesperson in a retail store, so your hurts level is low, then your works compensation risk is low. So it totally depends on different province and also depends on the level of your work. Okay, so that is the workers' compensation. So this is the form I just mentioned. This is a disbursement of payroll costs. I want to see if it's in there. This is a very typical disbursement of payroll costs for one employee by employer company. When you take a look at here, Hannah, the gross pay is $1,500. Then when you have this gross pay, you need to pay income taxes, right? For federal government, you need to pay income taxes for provincial government. You need to have a CPP contribution. You need to have your EI contribution. So those amount has been held by your employer, and then $1,111.57 will be your net pay. So the employee can take it home of this total amount. Then on the employer side, employer hold all those taxes, CPP contribution, and EI. Other than that, employer has to pay exactly the same amount for the same CPP and 1.4 times the EI. So that is the employer company dispersed is $1,605.78. So right now, currently, if the business or the economy is not very good, employer like to hire a self-contractor, right? Rather than employees, because if it's a self-contractor, they do not need to pay CPP and EI. The employees has to make the matches by themselves. Now we go on to record the basic payroll transactions. How are payroll liabilities recorded and reported in accounting record? Payroll system. In payroll, accuracy is very important. Unlike adjusting interest, this is not an estimate, it's the real happened amount. Not only will the government be auditing you, many of your employees will be. So accuracy is accomplished through a good record keeping in the payroll system. So we have like a payroll register, we have a payroll checks, we have employee earning records. Those components of the payroll system. We'll talk about each. For payroll register, the payroll register or payroll journal lists each employee's gross pay, deduction, and the net pay for each. The register assists companies in organization payroll data and is used to record the salary expenses journal entry for the period. So very similar to the cash payment journal. I will show you the cash payment journal later. Then payroll checks. The payroll checks usually have a attachment listed your gross pay, deduction, net pay, and that employee can return for the records. This is examples of a typical payroll check. Companies are paying employee nowadays, right? Less paid payroll checks, but more with an electronic funds transfer. So as evidence of deposit, most companies just issue to employee either a paper or electronic pay summary slip. The pay summary slips showing the data for that pay period. Very similar to the ones in there showing, but it's not a real check. It just listed your gross pay and your withholdings. Any question? No? Okay. Now, when we're recording the cash payment for payroll, most employer must record at least 3 cash payments for net pay to employee, payroll withholding to the government, payment to the third party for employee benefits, that is like charitable donations or dues or works compensations. So when the employer pays the employee, there is debit to salary payable and credit cash, of course, right? When the employer pays liability to the government and third parties, then the respective liabilities are debit and cash is credit. So CPP payment or CPP expenses or EI expenses and credit or cash. We're going to show there is a journal entries in there. Payroll interest, the first entry to record the employer salary expenses, which is the gross salary for all employees. The employer acts as a connection agent for all the income taxes, EIs, and CPP connection or union dues. Example. So the example is showing that accrue for the weekly payroll for December 31st to the 18th is $13,654. Take home pay is $10,002.28. So this is a net pay. Okay, there are 3 entries need to record it. So whenever you see a question, they give you a payroll information. They want you to do a journal entry. Always remember there are 3 different journal entries you need to record it. First one, you need to record accrued payroll for net wages, salary, or bonus. Number 2, record the employer share of EI and CPP. Number 3, record the payment of the net pay to the employee. So the first payroll, the entry to record the salary expenses and employee holdings. Now we see there's looks like they have office workers and salespersons, right? So that they divide those 2 different salaries expenses. One is office and one is sales. Now, when they credit on all the payable. So the income tax payable, Canada pension payable, EI payable, United Way payable, and salary payable. So that's how you record it on the payroll expenses for the pay period. Then when you move on to the next, when you need to pay the employer share of CPP and EI, you record it as employee benefits expenses. Payable is Canada pension, so CPP payable, and then the EI. EI is total amount times 1.4. Okay. Yeah, from here I want to see that because you know the CPP and the EI rates. I don't want you to memorize all those because it's not the purpose of this course. If you see a question from your final exam, the rates for the CPP and EI they give to you. So you can just simply use the rate. There probably might not be the current rate, but you just simply use whatever they give to you to do the calculation. Now the last one, when you paid off the net pay to the employee, you simply record it as debit your salary payable and credit cash. Okay, so that is a net pay. This is recorded payment of employee withholdings and employer expenses for the month of December. So we just put it all together. Now we have our EI employee income tax payable total amount, CPP payable total amount, EI payable total amount, and the credit or cash. This is total one. Those are the payment you need to make to the CRA. Now the United Way, that's is charitable donation, okay, for United Way payable. So that is optional payable. That employee can make a note to your employer. You're saying that you want to pay $620 for the United Way. So they could debit the United Way and credit the cash. So this because the employer made the payment to the third party. Okay. Now, independent contractor, so that's just a little bit different. Independent contractors, a company's payments to people who are not employee, they do not need to contribute to CPP or EI holdings. The employees or the independent contractors just make contribution by themselves. Earning records, we all know that the earning records is T4. It's end of the year. All the employers need to submit their T4 records for all their employees by end of February, because the deadline for personal income taxes is April 30th. If you owe money, no matter when you file your income taxes, if you file later than April 30th, you need to pay interest on that, a penalty interest on that. So the employer always has to file their T4 and submit to the CRA by February the 28th. Now the next topic is how are liabilities reported. There you go. Reporting current liabilities is illustrated in there under balance sheets. Now, note that some corporations may include less information than is shown in there, but maybe some of those companies will choose to disclose all this information in the notes, so it's not showing in the balance sheets. Now we see current liabilities. It's very detailed. We have accounts payable, salary payable, or estimated warranty payable, a GST interest. It's not going to show all the detail if you see a public company's financial statements. It will be less, but there have a lot of notes at the bottom. Now report current liabilities. We have a long-term liabilities. We have a notes table. Then, as we said that, you have to report the current portion of the long-term debts into the balance sheets. So you have your net long-term liabilities calculated. So the very last topic is exactly the same, like how does IFRS affect the current liabilities? Very similar to the account receivable. Remember the account receivable under asset is we use account receivable, right? But under IFRS, we use trade receivable. Similar to the liabilities. So under asset, account payable and account accrued liabilities are the usually terms we use. But for IFRS, we use trade payable or provisions. That's the only little differences on that. So that is for chapter 11. Now, before I let you go, I wanted to quickly go through a review of your final exam. Now, basically, it's covered only 4 chapters from chapter 7, 8, 9, 11. Okay. Now, as usual, when you see your level 1 exams, we have 20 questions. No, 40 actually. So you're gonna see 40 questions, multiple choices. Then you will have 5 or 6 question want you to download a journal entries or bank reconciliation form. But my suggestion, to make it easier, can you put your answers under the comments area? Because I do have some students send me the files, but I cannot receive it for some reasons. So even though they did all those 5 or 6 questions, but I cannot see it, then you are not going to get a credit on that. So if you could, please put your answers under the comments area. It's much easier for both you and me to do, to mark your answers. Now the very first one from chapter 7. Chapter 7, I want you to focus on the special journals, right? We have talked about there's a bunch of different journals. You want to make sure that you understand each, and you know how to, if you see a business transaction, you know how you're going to put those numbers into these journals. For example, we have sales on account, we have cash receipts, purchase on account, and cash payment. The rest goes to general journal. Now the sales journal. Sales journal, it shows record all the sales of inventory on account, right? So you have to record it like your account receivable and credit the sales revenue, because it's inventory, so you have two journal entries for cost of goods sold and inventory, right? But one very important thing for your final exam, read your question carefully, okay? Because I have a lot of students, the question probably shows you over 30 business transactions and people did all 30s. But read the question. The question probably just asks you to prepare a general journal. They do not want you to prepare for sales journal or purchase journal. They want you to do a general journal. So only do whatever the question asks you to do. Okay. They might just ask you to prepare a journals who will need to go to general journal and then just identify the rest of the business transactions. So for the rest of the transactions, may goes to, you could just simply says January 1st, it goes to sales journal, or January the 2nd goes to cash receipts journal. You do not need to list it. You just simply write it down and saying this goes to sales journal, this goes to a cash disbursement journal, something like that. So only list what the question asks you to do, okay? Now, when you see the cash receipts journal, which means you receive the cash. Very simple. You deduct your account receivable, increase your cash. Okay? Make sure you know that, how you're going to record it under which account. For example, let's see, there's November 12th, we record debit or cash $1,000. Okay, and then the other account credit, we use $10,000. So that is how you're gonna do for each journal. That is in our chapter 7. The next one, yeah, so there's also a cash payment journals, which means you pay cash, so you decrease your account payable. Purchase journals, which means you spend money or you spend on account, you increase your account payable, right? Liability increase, but you have your debit, your purchase. So that is purchase journal. Now we go to chapter 8. Chapter 8 is a big chapter because you need to understand the business bank reconciliation. We have been talking about this. I think I went through examples as well. You always following the steps. Okay, the steps is in your textbook or either in this PowerPoint. Always identify from the last year's bank reconciliation form to identify which account is go outstanding, which one has been paid off. So review the previous bank reconciliation information and then start doing your bank reconciliation by either bank size or book side. I don't care, as long as it's matched at the very end. So like for me personally, I prefer to do the bank size. So I adjust the bank side. We started with the leftover items on the book, and then we do bank arrows. When we finish the bank side, we move to the cash book side. Okay, start the book side, leftover items on the bank statements, and do record your book arrows. We do not require you to make a journal entries after you do the reconciliation. Basically, you just need to simply do the reconciliation. Now, this is very important. This is from our textbook as well. What this shows, it shows you the examples, and those are the most common accounts that you will see from, even though for real life or for your exam, right? There always some account have no change, including bank balance is always add deposit in transit, always subtract outstanding checks. Book balance, always add bank connections or interest revenue or EFT receipts, always subtract service charge, non-sufficient funds checks, and EFT payment. So memorize that. Even though you cannot get it balanced, at least you're on the way to get it balanced. I have some students they just simply give it up. when they find there's so much information they cannot even put into a bank reconciliation, or there's a time short of time they cannot finish their exam, simply put into whatever you know. It's definitely on the bank side or book side. Even though you cannot make it balanced, you still get some points. Okay, so do not make it blank. At least put something in there. So I know that you're actually trying to finish it. Now, the next topic in chapter 8 is petty cash account. Now I have to look for it. Where is it? The petty cash account, as we all know, you do not need to make journal entries on each transactions. You need to do a journal entry when you need to put more money in. Make it simple. How you are gonna do a journal entry on that? Where is the here? So this is examples shown from the PowerPoint, and also I think the exactly same examples from your book. When you replenish the petty cash, this is a very simple way to do. Is you always calculated your total account and then the cash on hand. Right? Use the 400, for example, for this one. Use the 400, deduct the total cash on hand. This is how much you need to put it back into a cash account. Right? I don't know if I make it clear. So, for example, this is because we opened account with $400 balance. What if after 2 months, when you need to replenish the petty cash account, they want you to increase this account to $500? Then we talk about this in our lecture, right? Then you need to put a petty cash account on debit with $100. Then make your cash change to 270 if your total balance increased. Okay, so you list all the expenses. You also need to add a petty cash account with the extra money you need to put it in to make it $500, and then credit the total cash. So that how you do a journal entry if you see those kind of things that you need to increase the account balance. So that is for chapter 8. Now when you go to chapter 9, account receivable turnover. So this is an interesting question because it's very simple, right? Calculation is so simple. Just use your net credit sales divide by average net account receivable. Normally the question will give you different years numbers. So you do not simply calculate for 2020, just simply use account receivable total amount for 2020. You have to use 2019 plus your 2020 amount divided by 2. That is how you calculate your average. Use the average amount, not the just current amount. Okay, so that is the one thing. I need to pay attention on that. 9, chapter 9, except that is the one example so we went through at the very beginning of this lecture is the aging to calculate the bad debt expenses. Okay, so make sure that you understand that part. And do the exercises. We do have a few extra class exercises for chapter 9 on that topic. Now the last one is the one we just went through for chapter 11, is the salary, how to record your payroll journal entries. Now this is pretty straightforward. I'm sure you're going to be okay. The only thing I wanted to emphasize is the CPP calculation. I don't know if you guys have been taking that payroll course yet or not. Probably not, hey? Then if you're going to go to your payroll course, you're going to have a detailed calculation on how to do a CPP calculation, income tax calculation, EI calculation. But for the purpose of this course, when you need to do the calculation, CPP, everyone in Canada has a personal exemption. What that mean? That means if you make $10,000 for a whole year of your salary, you have $3,500 personal exemption. So the first $3,500, you do not need to pay CPP. Okay, so when you do your calculation, make sure you use your annual salary deduct that personal exemption, and then times the CPP rate. Am I making it clear? So personal exemption for CPP. $3,500 per year. Very important. It's per year. It's not per pay. Okay. So when you do your CPP calculation, use your annual salary, deduct $3,500, and then times your CPP rate. So that is how you calculate your CPP. So we know that $3,500 is per year. What if the question only showed you monthly salary? So see employee A, monthly salary, 5,000. Then I want you to calculate the CPP payment. What you gonna do? Anyone?
Divide 3,500 by 12.
Exactly. Perfect, thank you. So the CPP calculation would just simply use 5,000, deduct $3,500, and then read.
Teacher,
Yeah. Because I see a lot of people are make arrows on that to make the calculation. So always remember $3,500 is for annual exemptions. It's not for monthly pay. Okay. So always remember to deduct that one. And by using your monthly payroll salaries, deduct the monthly CPP exemptions and times the CPP rate, then you have your CPP payable. Okay. So that is everything I need to talk about it before you go to your final exam. When you, okay, so pay attention to all those examples I just mentioned. If you are okay and get rid of all those problems, you should be totally fine for your final. Now, any questions on anything? We just talk about it. Nope. Good. Perfect.
yeah, wait, I have a question about exams.
Oh, sure. Yeah.
Do we have until Sunday to complete it?
Yes, you're right.
Awesome.
Yeah, we just got a confirmation from the school. You have till Sunday night to finish all your assignments, quizzes, and your final exam. If any of you require extensions, because I know that we had those students before, if you need an extension, send an email to what the APA online, the student services. They will help you to have extension. Because you know the problem is, if I submit your final exam, if I didn't receive any letters to inform me that you're going to have extension, I will submit your marks, and then you do not have access to the assignment submission anymore. So that's a big problem. So if you decided that you need extension, let me know as early as you could. So send me an email to APA services as well. So I know that you're going to have extension. I'm not going to finalize your marks until you submit everything. Okay? Clear? Perfect.
I did
Yeah.
ask for an extension a couple weeks ago, but I ended up not needing it. But I never did get a response from APA online. Like I did email them and I asked for the exemption, and I emailed them early Thursday morning.
Yeah.
And I never got a response.
Oh, Jesus. They're supposed to send me a letter that you want you to fill in and then submit them again, and then you got approved. So the whole procedure is to take a few days. But that's weird. You didn't heard anything from them though.
Okay.
But
I'm supposed to send you a letter or send you an email?
No, I don't have the rights to override your date. You have to talk to the student services on that. But if you ever, like, if you send it out email asking for an extension after one day, you haven't heard anything, send them email again just to remind them, because I guess they're probably very busy for some reason.
Okay.
Yeah. Yeah, but definitely let me know, because sometimes if you send an email to them, they forgot to inform me, and after I finalize your exam, we're all screwed up.
Okay.
Yes. Yeah, yeah. If you do need extension, let me know. So I know that, well, I'm gonna leave your marks blank. Okay?
Okay.
Okay, perfect. Any more question?